Let's pretend we are running a grocery store. And in our grocery store, we sell soup. And so we sell cream of mushroom soup. That's one of the items that we sell. And one day we say, all right, we need to buy some soup to put on our shelf. And we buy 1 can of soup. And we pay $1 for this can of soup. Okay. And the next day we say, you know what, we need some more soup. We're going to go buy another can of soup and put it on our shelf. This can of soup cost us $1.50. So prices have gone up a little bit, or a lot. And we're like, well, that's still not quite enough soup. So we buy another can of soup. And prices continue to go up. This one cost us $2. And then finally we say, all right, 4th day, you know what, we need some more soup on our shelf. Let's buy one more. And this one is going to cost us $2.50. So we have 4 cans of soup on our shelf. They each cost us a different amount. So first one cost $1, then $1.50, $2, $2.50. And then we have a customer come in and buy one of these cans of soup. And let's say we sell our customer, they pay us $3 for the can of soup. And in the journal entries that we were doing before, remember there's 2 journal entries when we make a sale. The one is how much did the customer pay? And in this case, the customer paid $3. How much the soup cost us, that doesn't change what the customer has paid. So we would debit cash $3, credit sales revenue $3. The second journal entry is recording the inventory leaving our store, and we need to come up with a price of how much that cost us. And so we debit cost of goods sold for an amount and credit inventory for a certain amount. Right now, what we have in inventory is a total of, let's see, so $3 plus $4, $7 total, I think, in our inventory right now for our soup. So when it leaves, the customer just went and picked a can of soup off the shelf. And when they brought it up, there are 4 different ways for us to figure out how much that soup cost us. And so we're going to illustrate the 4 different ways now that we can figure out which can of soup did we sell our customer. And the first one is specific identification. If we know which can of soup we sold our customer, we just use that. For example, if we know the customer picked this $1.50 one off the shelf, what goes in our journal entry is $1.50 for our cost of goods sold, because we know exactly which can of soup it was. Now, that works for industries that have ID numbers on their inventory. Our cans of soup don't have ID numbers. I can't tell one can of soup apart from another one. They have barcodes on them, but guess what? The barcodes are all the same. So I can't tell one can of soup from another can of soup without these Post-it notes on there. They all look the same. So I can't really tell which is which. But industries that this works in that have IDs, it works really well. For example, if you go to an auto dealership and buy a car, they know exactly which car they sold you. They know exactly how much that car cost them. And so they just use that amount in the journal entry saying, I know exactly which car I sold. I know exactly how much it cost me. So that's the first way, specific identification. The second way, the second and third ways we're making assumptions. Now, it might not match reality, and that's okay. We are making assumptions about the can of soup that our customer bought. Again, we don't know exactly which one they bought, so we have to assume. The first way is called first in, first out, or FIFO, F-I-F-O. And in that method, we are going to assume that the first one we bought is the first one that we sold. So if our customer comes and buys a can of soup, we are going to assume they bought this one, the oldest one, the first one that we bought. So what would go on our journal entry is $1 because we are assuming they bought this can of soup. If a customer then comes in again later and buys another can of soup, we are assuming that they bought the next oldest one, this $1.50 one, and so on. So first in, first out is we are assuming we have sold the oldest things first. So what goes in our cost of goods sold is the oldest costs. The opposite of that is LIFO, last in, first out, L-I-F-O. And in that one, we are assuming that the customer purchased the newest item. And so we'd say, well, which item did the customer buy? It must be the newest one that we bought, and the oldest ones have stayed on the shelf. And so we would say, hey, the customer bought the $2.50 can instead of the $1 can, because we are again assuming that they bought the newest one. And then if another customer comes in, the next customer bought the $2 can, and we're left with the oldest things on the shelf. Now, which one does a grocery store probably use if they were choosing between FIFO and LIFO? In a perfect world, a business would use one that matches their reality. In a grocery store, they're probably trying to get customers to buy their oldest items first. Otherwise, they'll spoil, right? So if you're stocking the shelf, you probably put the newest things in the back. So you'd probably stock the shelf like this so that the customers will buy the $1 can first, and then the newest things are at the back. So customers won't be able to get to the newest things until they buy the oldest things. So that's probably how they stack the shelves so that customers will buy their oldest stuff and so that things don't spoil. Think about milk and how they stack milk in the refrigerated section. They push all of the old stuff towards the front where the customers can get it, and then put the new stuff behind that in the back. Now, does this stop a customer from reaching back and buying the oldest thing or the newest thing? No. So a customer could reach back and buy this $2.50 can. We're still going to assume, again, that they're buying this one because we can't tell the cans of soup apart. So we have to make some assumptions, and we can't track these cans of soup individually. All right, so that's FIFO and LIFO. All right, so the last one is an average. We say, you know what? It doesn't really matter if we sold the first one or the last one. And we're just going to say, let's just take an average of the cost of everything. Now, this is the most math-intensive one because whenever we make a purchase, we have to recalculate the prices for everything. Let's demonstrate that. So, we bought this $1 can of soup. Right now, our average is $1 because we have the total that we've spent is $1 and we have one can of soup. So calculating the average is $1 divided by one can of soup. That's 1. So $1. It becomes more complicated now if we buy another can of soup. Now we need to calculate the cost. Again, the average cost for everything. Right now, the average cost is $1.25. And so instead of saying this can cost $1, we're going to say both cans cost $1.25. Like that. Okay, so we have spent, how do I know it's $1.25? I spent a total of $2.50 on cans of soup, and I have 2 cans of soup, so $2.50 divided by 2 is $1.25. All right, let's add another one into the mix. Now I have $2, so I have $4.50, and I need to do some math very quickly here. It should be $1.50 now is the average for everything. So once I buy this $2 can of soup, I recalculate the average for everything. And so now everything is $1.50. So I'm going to replace all of the tags on everything and say, all right, everything is now $1.50. And one more here. So now if a customer comes in and buys a can of soup, I say everything costs $1.50 to me. So again, this does not affect what the customer is paying. Before we said they are paying $3 for a can of soup. And all we are trying to figure out is what this costs us. So under the weighted average method, we're not assuming the customer bought a specific can. We don't actually care if it's the newest or the oldest ones. They all cost the same to us because we said, what is the average cost? So we just say, all right, customer bought a can of soup. They all cost the same to me. I'm going to use $1.50 in my journal entry for cost of goods sold. Now, after the customer has bought a can of soup, I don't have to recalculate the average because the average now is still $1.50. I have spent a total of $3 on soup and I have 2 cans of soup. So the average has stayed the same. I only have to recalculate the average if I buy something new. So for example, I go buy this $2.50 can of soup and now I have to recalculate the average for everything. Sales, I don't have to recalculate it. Purchases, I need to update all of my average prices for everything. All right, so those are the 4 methods. Specific identification, often used for car dealerships or businesses that can uniquely identify their inventory. Then there's FIFO and LIFO. So FIFO is assuming I am selling my oldest thing first. The first thing I bought is the first thing I sell. LIFO is the last thing I bought is the first thing I sell. And then there's weighted average, which is where everything costs the same, and I recalculate that cost every time I make a purchase. I just want to emphasize one more time that all of this does not actually change what the customer is paying and what the customer sees. The customer does not care which cost flow assumption I am using. Their experience is the same no matter what. So in our scenario, the customer was paying $3 for a can of soup. All we were trying to figure out is what that can of soup cost us. So that second journal entry, the cost of goods sold and the inventory, that's what we are trying to figure out, is what do we put in that second journal entry. The first journal entry with the customer doesn't change anything.